Welcome to American Issues Take One. I'm Tim Apicella, your host. Today's title is The Feds Protect All Bank Deposits Over $250,000. Back in 1933, the Banking Act created what is called the Federal Deposit Insurance Corporation. What the purpose of that new law in 1933, remember 1933 was pretty much in the middle of the Depression, where in 1928, 29, there was a run on the banks. The stock market had crashed. People were worried about their deposits in the banks. And there was certainly a massive rush on all banks to get people to get their money out. That caused problems even greater than the stock market crash. So that law was created. And as a result, if you had your deposits here recently of $250,000 or less, no matter what happened to that bank, your money is protected and guaranteed by the federal government. As of this week, President Joe Biden said that we're not only going to protect your deposits under $250,000, but any amount of deposit over $250,000. And that's a big development. So to discuss that development for today's show, I'm going to go to my guests. With me today is my special esteemed guest, Chuck Crumpton, and our contributor, Cynthia Lee Sinclair. Good morning.
Morning.
Morning, Tim.
Talking about banking isn't a lot of fun. It's kind of a snore fest. This is a good show, maybe, that if you have insomnia, this topic may, well put you to sleep. But it's an important topic. And the reason being is most Americans have their money either in real estate, the stock market, or in their investments in banks. And so when a major regional bank goes underwater, and it appears to be for fairly simplistic reasons, that should have all our attention, whether we pay attention to banking or not. So good morning, and Chuck, to you. You've been watching the news stories, and what have you been able to glean from the news stories that why Silicon Valley Bank actually went out of business, or certainly had a liquidity problem that caused a panic and a rush for everyone to try to get their money out of that bank?
Well, one of the things that the media hasn't really picked up on, but it seems pretty evident to those of us who put this in any historical context, is the Trump years of easing regulations, freeing up and giving free rein to businesses at all levels, from local and regional on up to national. The piper is being paid. What goes around is coming around, and whether it's railroad derailments or bank and finance failures or educational wars, healthcare, it's in pretty much all areas, and we're going to pay for it, and you can't Band-Aid it.
It seems to me it's not
fix it.
It seems to me that we've been here before with the fairly liberal guidelines of banking under the Bill Clinton administration that led up to the 2008 one of the largest financial crises this country's ever experienced. In fact, it was a worldwide financial crisis because it was a contagion that spread. It doesn't seem to be any particular administration, whether it be GOP or Democrat. It just seems to be our oversight, our regulators either aren't catching it or they are catching it and nothing's being done about it. These aren't too dissimilar to what I just said, is that our 2008 financial crisis could have been avoided, very easily avoided, had there been sufficient regulatory oversight. So I agree with you wholeheartedly, Chuck, that the media is not picking up on that point. Cynthia, what's your take on this whole thing?
Well, I think that regulations do have a lot to do with it. And the fact that they weren't followed, like you said, the people who come in and do the oversight. And didn't they just do an oversight panel with this particular bank? but they just didn't catch any of these bad investments. That's what I think is an important factor here. They put, and I hate to diss the government, but they put all their money in government bonds, and well, not all their money, but they invested heavily in these, government bonds. And then, of course, the floor fell out and everything, they lost a bunch of money. And so that was a big factor in why this happened. And we got to remember, this particular bank even lobbied heavily to get those regulations revoked. So, you make your bed, you got to end up untangling the sheets yourself.
Right. No, that's a good point. And you are correct that, Silicon Valley Bank bought billions of dollars of government treasuries. And I think part of the problem was, let's say, for example, they bought $50 billion of treasuries, which is a very stable instrument. It's one of the most safest instruments because it's backed by the federal government. And let's say they bought 50 billion at 3%. So they're getting 3% revenue on that. And then, but to buy those treasuries of 50 billion, they had to rely on deposits of 50 billion. And what were they paying to depositors for that 50 billion? Probably like half of 1%. So the margin of what they were paying for the money to buy those treasuries was so low, and they were getting 3%. That was a 2.5% profit margin. The problem was, because this was short funded with liabilities of 3 months or 6 months or 1 year, when those matured, they would have to pay higher rates to them because the feds were raising the rates in the last year, right? And so now that margin was getting more and more compressed. And what ultimately happened is the amount they're paying for the deposits of that 50 million now exceeded the $50 billion of those treasuries that were paying them 3%. So that's also a big problem with it. And I think you're right about the type of loans they were making. And that is squarely on the doorstep of the Fed regulators, both FDIC and other government entities that monitor banks. So you do rely on the bed that you made. The question is, what should we do about it? Is it the regulators' fault, Cynthia? Or do you think there's some culpability with bank management that really was asleep at the wheel? 2008, no one went to jail really, except for Countrywide, the CEO of Countrywide Mortgage, but really no one went to jail. What should be the consequences, in your opinion, with a bank that has mismanaged its portfolio so badly and has put really us all in this kind of a quagmire?
Well, that's what the FDIC is for, correct? I mean, that's what it does, is it insures the people that have deposited into these banks that collapse. So, one of the things that I heard over this last week that has just really keeps ringing in my head is what Elizabeth Warren said in an interview about banking is supposed to be boring. And I thought,
that's what I said in my intro.
We've got all this, it's so exciting. All this money is lost and all these people are trying. And yet, so it's 24/7 being talked about on the news. And I think, is that going to be the thing that pushes the panic? Is the kind of coverage that they're giving it? It's not, every time they bring it up, it's not just one bank has gone under, or the Signature one also. But it's not just one bank. It's watch out. Are we supposed to be worried? Is everyone going to run their banks? And instead of every time it comes up saying you don't have to worry, this was a limited thing. No, they don't say that.
Did President Biden?
Yeah, but
Did President Biden give you confidence that all was well?
Yes, he did. I felt much better after listening to him. And then I heard all the Republicans talking about how the only reason the bank went down was because of woke policies and I thought, that's crazy. It was bad management and no regulation, in my mind anyway. I
think you're spot on. And I know you're not a finance person or a banking expert, but your observations are spot on. Chuck, to you, Did President Biden's message to the American public the other day, did that instill confidence, and did it work?
Well, I agree with Cynthia. I think it helps, but I think the more important factor that the media is not only not investigating and exposing, but actually getting sucked into following and supporting is the claim that these investors and monies that tanked Silicon Valley Bank and Signature Bank, that these were woke liberals. Give me a break. Yes, a bunch of the investments were in climate change areas, but the nature of the investments that made them so risky and dangerous financially was that they were short-term turnaround, quick profit, the classic greed model that got us into trouble in 2007, 2008 with the syndication of mortgage-backed securities, which you're extremely familiar with. And what are the parallels, Tim, that you see between that crash of much larger financial institutions and this crash of more local and regional ones?
Well, in my mind, you could have all the laws on the books that you want, but your laws are only as good as those individuals who are charged with enforcing those laws. And to a certain degree, we had those laws on the books back in before 2007. For example, when you packaged a loan, a bank had all these mortgages and they packaged a loan and then they sold them off on the secondary market to Fannie Mae and Freddie Mac. Those were supposed to be clean loans that were written to specific guidelines, underwritten to certain guidelines on what should have gone into those pools before they were sold off. And clearly things were being defrauded. I mean, all sorts of terrible, bad loans were being put in those pools that should have never made it in the pools. So the question really was where was Fannie Mae and Freddie Mac back in the day to ensure that the mortgages made those pools were clean and legitimate? And there was no oversight. Yet the rules were in place, and they were just not enforced. So that's my answer to your question. And it's unfortunate in this case with Silicon Valley Bank, is it would have been fundamental responsibility for the oversight regulators to see the mismatch in their assets versus their liabilities. Yet that was missed. It's like you're in the middle of the ocean and you see all this water on the bottom of the boat and you're going, "Que pasa?" But you just keep on sailing. You don't investigate. And that's kind of what happened here to a certain degree.
No, and your point's a really important one, Tim, because it highlights two things. One, that the most important, critical, fundamental duty of the regulatory agencies is the monitoring. What is the financial health? What are the components and the elements? Check the vitals and act on them if the blood pressure, the cholesterol, the whatever are not where they should be. And
I think you're creating a case to clean house on the regulators. I mean, if they're not doing their job and enforcing the rules on the books, maybe it's time to get new regulators that will know how to do that. And I think that's part of the problem. The partial solution moving forward is you're only as good as your regulators to provide the oversight. So I think
that's certainly true, but I think it's equally true, if not more, that if you create the mentality in the regulatees, the financial industry, that the regulators are their enemies. The more you can hide, the more you can deceive, the more you can disguise, the better off you are and the more you make. That's the mentality that led to 2007, 2008. And at least from what I can discern, that's a major causative factor here as well. It's that inimical, that relationship. It's not just the people on both sides have to be collaborative. They have to be willing to share information in ways that benefit both. The regulators to serve their duties in monitoring and maintaining compliance, but also the industry, the financial industry, in tailoring their behaviors and their communications and their data so that it will not just reflect, but actually manifest and build compliance.
You know, that you are so correct on saying that banks will try to, they won't necessarily hide what they have, but they certainly won't shine a light on it. And they certainly won't, you know, when those auditors come in, they're kind of put off in the side of the corner somewhere. And there's certainly not, wayward signs saying, hey, look at this might be a problem. No, you're right. They try to not disguise it, but they try to make sure that it's not obvious. Good point. And I don't know if there's ever a day where a bank will share those risky type investments with a bank auditor or not. By the way, Chuck, every bank has its own internal bank auditors. It's not just outside regulators. They hire a team designed to do that very thing. So before the outside regulators come in, they've hopefully caught all the problems that may be discovered. So it's interesting to say what happened to the internal auditors of Silicon Valley Bank as well.
Well, I mean, honestly, Tim, that's like asking the HR department at a major company, how come you have all these employment, workforce turnover, discrimination, all kinds of other problems? You know, if your monitor and enforcer is somebody who depends on, is directed and controlled by, and is in the pocket of the people who make the most money at the top of the food chain, you're not going to get management of that activity. Hey, you're going to get a mouthpiece.
Yeah, they only get caught on the carpet when something blows up.
Well, and look at, in a friend who was very active in real estate and financing, he said, Chuck, the biggest change after 2007, 2008, when some of the crackdowns and the new regs came, was in the Fannie Mae, Freddie Mac appraisers. They went out there and they really did their job. They looked for problems. They looked for things that would make an investment risky, problematic. And they nailed those to the T and required all that stuff be corrected before the loans and the transactions and the commitments would be made. When that falls apart, because you've got people on one side doing whatever the top of the food chain wants to line its pockets and therefore trickle down a little bit to them, you're not going to get that monitoring or the enforcement or the information sharing. That's
great point. Great example too. I distinctly remember back in the good old lending days of the 1980s, realtors would call their mortgage guy and say, I want so-and-so to be the appraiser of this house I'm going to sell or this apartment complex I'm going to sell. They would actually request the specific appraisers. So things have changed a lot since those days. Chuck, what do you think about Joe Biden's new rule change about covering all deposits in excess of $250,000? Do you think that was what's your take on that one?
Well, look, if there's any area where Joe Biden demonstrates consistency and some strength, it's a very, very common sense approach. What's at the crux of the problem here? The other thing he does pretty well, his leadership people, his choices are really solid. He picks the people who know those areas better than anybody. And I got this firsthand from Brian Schatz. He said, Joe Biden's two biggest strengths are his selection and his faith in his leadership team and his closeness to them, responsiveness to, and it's just being a decent guy. Mm-hmm. The common sense response to what for the people is at the core of this crisis. It's a loss of confidence that created the run. It tanked the bank. If you want to correct that problem, the best thing you can do is take action to restore that confidence.
I was impressed on the speed in which our Janet Yellen and company got out ahead of this and actually contained the contagion, which is to say fear and lack of trust in the banking system. I did not expect that from my federal government. And they were so quick and so fast to head this off before the media even knew what was really going on. They were right on top of it. So if anything, kudos to the Biden administration on its fast and swift ability to get ahead of a panic and a fear scenario.
Well, and equally important, Tim, they were cohesive and consistent. You heard the same things coming out of Yellen that you heard coming out of Biden, coming out of a local guy. They've attempted to do that to the best of their ability with the Ohio derailment situation with the EPA director and Biden supporting. That's a much more complex situation in a lot of ways because you've got interactions between environment, health, fossil fuel industry, energy, a lot of areas that are virtually impossible to coordinate because the dominant forces have been divisive and competitive and successful at that for so long, since the 80s and the Reagan stuff. If you look at movement conservative and you read some Heather Cox Richardson on what's been happening the last 43 years, it's scary, scary, scary stuff. And there's some pretty scary things out there right now.
So. Yeah, I agree. Thank you, Chuck. Cynthia, I saw your finger go up when we were talking about the speed of the Biden administration to get on top of this potential very, very huge crisis that could have infected all sorts of banks as far as panic and fear from their depositors. What was your point you wanted to make?
Well, Jerome Powell, isn't he kind of a leftover? And I've heard some feedback from different people online and on the TV in regards to the fact that he kind of cooled his heels and drug his feet in the beginning of this, whole resurgence and coming back to life after the pandemic. Whereas if he had maybe raised those interest rates a little sooner, maybe we could have avoided some of this because it would have tamped down some of the inflation sooner. And I can't help but think that that's, maybe in there too. I don't know, as you said earlier, I'm not a big financial whiz. I don't know much in regards to that kind of stuff, but it struck a chord for me. And it always sort of strikes a chord when I hear about an issue involving a Trump leftover, someone in the administration that's still there, that in my mind, he should have just cleaned house. And I'm not quite sure why Biden didn't do that. And I wonder, if that isn't another sort of cog in this big wheel, because there's no one thing we can point to, right? That this is why it happened. But, it's all.
We may get to that because they're going to conduct an investigation. So we may actually very well get to the bottom of what was the specific cause of this bank run and what led up to it. So we'll see about that. But
they're going to find that it was a bunch of different things that all went together to make this happen.
Right.
You wonder, looking back on history, if there's going to be a need for some sort of an extreme response to all this, like when Nevada in 1933 declared a 12-day bank holiday, right? That eventually turned into a country, a national bank holiday where they just closed all the banks for 10 days so things could kind of catch up. And you wonder if that's something that needs to happen, maybe now in this situation as we're going forward, instead of trying to close the door after all the animals are out. Let's try to close it first and keep the animals inside.
Okay. Animals. I love that analogy. Cynthia, it wasn't more than 2 days ago that Bank of Hawaii had to have its own little bank holiday. They shut down trading on its stock because it lost so much value in the course of hours. And of course, they opened it up back up again, and Bank of Hawaii has recaptured a lot of its stock value. But it's not just banks closing. It's you stop trading on a particular stock if it's going way out of whack so rapidly.
Right. So maybe this is something that can happen now. It worked in 1933. So, it worked for Bank of Hawaii recently. So maybe it is something that's not that far-fetched to be looking at, right?
Yeah. Let me ask you a question that was related to a conversation I had last evening with someone. I mentioned, the big Valley Bank takeover by the federal government and Signature Bank. And the individual admitted that they just don't watch TV. They don't like to watch the news. And I certainly understand that. It's stressful. But the first question that came out of this individual's mouth is, so how safe is my money?
Yeah. People are
So when you first heard this story come out, did you ask yourself that question?
Sort of, but not really.
Okay.
I bank with Bank of Hawaii, and I really trust Bank of Hawaii. So because I believe in their, when they are all about closing the door before the animals are out. So I thought that was a really good thing that made me trust my money in there. But I also have some money in Wells Fargo, which I don't really trust at all. So, it's a big bank, so it's not quite as, at risk as some of the other ones, but it still, gave me pause for a moment. And then when I heard what was going on, and I did a little research, and I heard from Joe Biden, President Biden, that our money is safe and that they are taking, action to be protective instead of just after the fact. They're trying to do things that are proactive, and that alone made me feel better.
Let me ask you a question I asked Chuck, and that is, do you think it was wise for President Biden, and first, before President Biden was our treasurer, Janet Yeltsin, do you think it was wise for them to extend a guarantee of all deposits in all banks over $250,000? Second part of that question is, would you consider that maybe a bailout by the taxpayers?
Well, that Biden is being very careful about not using the word bailout because he doesn't want to trigger that same, 2008 trauma. I don't know what else you call it. But so I think that was important. But I would like to see all of our media people really start to talk about the FDIC and explain what it is to people. This isn't taxpayer money paying off these, these investors and these people that are contributors to these banks, investors. So at any rate, I thought that was an important an important thing that people know. But I would like to hear people explain that, this isn't taxpayer money that's going to be making these payoffs. It's insurance companies. It's the government insurance company.
Yeah. Well, let me throw this out to you. You could argue that, yes, you're right. You're absolutely correct that FDIC is an insurance fund, if you will. It's an independent federal agency, but it's an insurance fund that all banks pay into. However, those premiums are based on deposits of $250,000 or less. If going forward, it's open season on all deposits, which I don't think it is at this point, but if it is, wouldn't by definition all those banks now need to pay a higher premium to insure higher funds? And what do banks do when they have to pay higher fees on anything? Do they not pass that along to the consumer? So in a roundabout way, could this not be perceived as a taxpayer bailout?
Well, not exactly, because the bailout, is for the, I think what it is we're, yes, going to pay a higher maybe interest rate or whatever it is that we're going to be paying to the banks. Isn't that worth it to know that our money is insured?
Absolutely.
We insure our cars so that if they get wrecked, we can get the money back out of them.
Yeah, absolutely. It is worth a higher fee or higher percentage of interest rate. So good point.
Depending on how much money you've got in the bank, you're going to be paying more, and then you're looking at that reimbursement if something fails for that bank. I think it's well worth any raise in the interest rate or that, the fees that you pay the bank to know that you are for sure insured. I think it's important.
Okay, thank you. Hey, Chuck, last question before we go to final thoughts. Do you think it's wise to continue to insure all deposits in a bank? And if so, is that feasible?
Well, a couple of things. Got to step back and think, okay? First of all, doing that, it's a contingent liability. Banks are not going to feel the necessity to cover it with liquidatable dollars, cash on hand. Ideally with reserves, but even reserves will include projections, investment returns, stuff like that. So banks make their money off investments, just as insurance companies do. And there are others as well, but they're third-party investments. You don't see banks investing in banks or insurance companies investing in banks or insurance companies. The finance industry doesn't invest in itself in that way. So their investment really is and has to be the building of sufficient financial stability and access to reserves, the ability to acquire and make reserves available through resources that they have that can cover the contingencies that they deem to be sufficiently likely to need to have available. That's a much lower number than the total. So that's what they're working with. It's a realistic risk assessment, investment assessment picture. But the question I come back to is, unless you master the timing, as Cynthia has said, to do that preventively, and unless you master the relationships between the financial institutions and the investment elements out there, developers, capital, venture capitalists, others, unless you make those truly collaborative and information sharing and risk sharing, you have increased the risk and the exposure and the likelihood of the severity of its impact unnecessarily and exponentially. That's what we got. But look where that came from. Look who the competitive, high risk, trust your money people. Look where that's based. It's Reaganomics, it's trickle down, it's the movement conservative for the last 40 plus years. And they're locked in at that. And now they're engaging in a culture war to try and maintain just enough voting support to be able to maintain that oligarchy, financial oligarchy.
That's a great point. And I keep thinking, not only do we have this recent, mini crisis, but we had the major crisis in 2008. Lest we forget what happened in the late to mid 80s with the financial crisis of the savings and loans. And again, to your point, the transparency between investor and institution is blurred at best. And certainly the transparency between the institution and regulators is more than blurred at best. So, Chuck, really great points, and I really appreciate that.
Well,
we've run out of time. Yes, go ahead, Chuck.
Right, just one other thing real quickly. The finance industry and the economy are a climate change mirror too. They have a history. Every 15 or 20 years, major financial economic disaster happens because we're not doing the preventive collaborative management of the elements in the way we need to.
Well, should taxpayers demand that our government, regardless if it's GOP or Democrat, that we learn from history and place preventive steps? Obviously, what we're putting in place isn't working.
Yeah, it's obviously broken, but they're not going to demand that because they have been sold by this whole movement conservative group on a zero-sum game that we deserve more, we're entitled to more, and the only way we can have more is to take it from those who have been traditionally excluded, disempowered, and marginalized. That will continue to expand. The wealth gap in this country, the power gap, the education gap, the healthcare gap, all of that will continue to expand as long as that movement continues to acquire its allegiance through not disinformation, but intentional misinformation.
Wow. That's a fantastic perspective. And
it's not what we meant by make your bed and lie in it, but that's what they do.
Yeah. Very well worth remembering what you just said for all of us.
Remember in November.
Yeah. Hey, last thoughts. Cynthia, to you, what's your last thought on this whole business and any recommendations?
Well, first I'd like to agree with Chuck, what he said about every 10 years. And if you look right before that every 10-year fallout problem, they roll back regulation. Then they put the regulations back in place. And
Very true.
they roll back the regulations, and then it happens again. So I think it is all very tied to this, regulatory arm. And I think it's so important that we have those regulations in place. So my closing remarks, just to make fun of the Republicans, I have to, because it's so ridiculous what they're saying. They're making the connection that because this bank was invested in tech and in some climate stuff, they were more new age progressive things that they were investing in, that it is a woke bank, and that was the problem. So the best one comes from Ronnie Jackson out of Texas, right? GOP representative. He claims all of this is due to the Silicon Valley Bank's woke agenda, claiming that the company wasted money on ESG policies and CRT crap. And he was referring to critical race theory. Now, where that comes into this banking is beyond. So that's why it's so ridiculous. And this is an echo of all of them. This isn't just Ronnie Jackson's words, but these are specifically his quote. How much money did they waste on financing ESG CRT crap? The insane left-wing agenda is bankrupting our future. Go woke, go broke, Jackson tweeted on Monday. And these are the same as what all of these guys are saying. I tune into Fox News regularly just to see what kind of nonsense they're spewing. And
could you not use the term news when you say Fox News, please?
Sorry. Thank you. Yes, I know. I can, because it's ridiculously not news. At any rate, every single one of the times that I would chime in, was just ridiculous. That's all they're talking about is the woke issues. Woke banking is what caused this. It's not just, right up to, ex-Vice President Mike Pence saying it's all because of woke policies. Trump, woke policies. Ronnie Jackson, woke policies. Every single one of the newscasters,
I think I got you wound up.
The opinion makers, it's all they had to say. The only reason this happened is because of woke policies.
All right. Thank you, Cynthia. Cynthia, I bet we wouldn't lose money if we were to make a wager that woke will be the new phrase, the new word of 2024. Something tells me it will be. And we would not lose that bet. Okay, thank you, Cynthia.
We'll be swimming in pizza then.
Yeah, exactly. Chuck, you get the last thought, the last word. Your last one before I went to Cynthia was spot on and very, very memorable. But here's another chance to do the same.
Quick point. As one late night host put it, it's not whether they're a woke bank, it's whether they're a broke bank. How did they get there? And what should we do about it? That's the question. That's the question that one party is not asking and doesn't want you to ask. That's the question that the other party is attacking head on. Which choice do you want to make?
There, we leave it right there. Profound rhetorical question. Thank you. I would like to thank my special esteemed guest, Chuck Crumpton, and our continued contributor and real asset to the program, Cynthia Lee Sinclair. I want to thank you both for appearing on American Issues Take One. I'm Tim Apicella, your host, and please join us next week. And until then, aloha.
Thank you so much for watching Think Tech Hawaii. If you like what we do, please like us and click the subscribe button on YouTube and the follow button on Vimeo. You can also follow us on Facebook, Instagram, and LinkedIn, and donate to us at thinktechhawaii.com. Mahalo.